Hi, Scott Nelson, Senior Wealth Manager with Boulay Financial Advisors. Today we have a special market update for you. I'll be discussing the markets with Chad Carlson, Chief Investment Officer, Boulay Financial Advisors, to get his perspective on things. Chad's been with Boulay for over 20 years. He's held various roles and responsibilities, and so he has a wide experience of the financial planning process. Over the last 10 years, Chad's primary responsibility has been managing client portfolios and doing the research and due diligence on the investments that are in those portfolios. Chad, thanks for joining me today.
Well, thanks, Scott. It's good to be here. Thanks for sharing the limelight with me. This should be fun. I'm looking forward to it.
Yeah, well, the limelight's not that big, and you and I are not that svelte, so we'll try to both squeeze in and move on. Chad, before we start talking about the markets, could you explain or give an overview of the approach, the investment process that Boulay Financial Advisors uses to manage client portfolios?
Definitely, Scott. You're going to see a graphic in front of you that kind of breaks our philosophy and our core process into three areas. Fundamental analysis, what we call trend analysis, or what some people might call chart analysis, and then tax location or tax efficiency within the portfolios. And if I'm allowed to kind of give a little bit more of a deep dive into each one of those sections and how our process works week to week, Scott, you're part of this process. You have a CFA. We have Michael Johnson, who probably about the time most of you are watching this will be passing level 3 of his CFA. So we've got some smart guys on that team. We meet once a week and basically in our due diligence meeting, and that's where we try to, from the fundamental side of things, figure out, hey, should we be picking a mutual fund in this investment strategy space or in this investment sleeve that we're talking about? So say we're looking at the large cap value sleeve, right? Mm-hmm. We'll all meet and come together and use the software packages and everything else that we have that gives us a pretty good view as to say, hey, we should use this mutual fund over that mutual fund or this ETF over that mutual fund, right? Now, there's differences amongst all of those things, Scott. You know this as well as everybody else, but ETFs, they tend to be a little bit more tax efficient and trade for free, whereas mutual funds, the ones that we use, tend to trade with, I think in our case, about a $15 transaction cost. So we weigh all that, come together, and we try to make the best decision we can from a investment strategy standpoint. Then, once we have all of the products that we're using, we kind of move on to that trend analysis. We have another group that meets, we call it our asset allocation team. And you'll probably see a little bit of an example of the work that we do, or at least a little part of it here in the rest of the kind of our conversation here. But that's where we meet, and basically once we have the investment strategies or mutual funds or ETFs that we've selected in the due diligence team, that is the meeting where we all kind of come together and say, hey, this is how much of each one of those strategies that we're going to utilize. Should we be overweighting emerging markets versus domestic assets? Hey, we should have a little more fixed income. Those sort of decisions based on longer term trends that we can see that are clearly in place within the markets. And then, Scott, I don't know if my bio will have flashed up in front of everybody, but I still have CPA behind my name. Yeah. So once all of that is put together at the end of the day, we still have the, kind of bleeding through from our tax background and our CPA background that we came out of. Our trading team goes in and will implement client portfolios in the most tax efficient manner that we can. What does that mean, right? That means like within an IRA account, any money that you take out of an IRA account is going to be ordinary tax or ordinary income tax on your tax return, right? Yeah. And so when we have investments like fixed income that are producing ordinary income, well, we want to put those within that ordinary income tax bucket called the IRA. Whereas if it's a Roth IRA and that's tax-free forever, maybe we want to have the more aggressive and more historically outperforming assets on the equity portion of the portfolio within that sleeve of the client's portfolio. So we do what's called tax location. So at the end of the day, we try to add some sort of value on each level of that process and walk away with a good process at the end of the day. So that's a broad overview of things. Maybe we'll see a little bit more of that as time goes on.
Yeah. All right. Thanks, Chad, for that overview. Now, moving on to the equity markets, we were down significantly in 2022. We rebounded in 2023. Where do you see the market standing as we start 2024 for the U.S. and overseas?
Well, we saw a nice rally, basically from the end of October up through what I would call current day here in the new year. If you're going to ask me and pin me to the wall where I think we're going to end 2024 on, I've been around long enough not to make those calls, right? We've all seen that Wall Street Journal article at the end of the year where they put all the economists in front of you and said, "Hey, this is where it's gonna end up at the end of the year," and then it shows how wrong they are. But what I'll say is, and maybe to exhibit some of the asset allocation team's work, you'll pull up on the screen and what you'll see here is a chart of the emerging markets versus the S&P 500 or the SPX. So the EEM there, just so for those of you at home looking at the chart, when that chart is going up, emerging markets are outpacing domestic assets like the S&P 500. When that chart is going, no, not since. It hasn't happened much at all since about 2011. And so we can see that, and this is the stuff that we look for within the asset allocation team, and use some of the technical analysis tools that we have available to us. That's a clearly defined trend that's been in place for a very long time. And so at the end of the day, that means within our portfolios, we might shade, or in this case, we've actually vacated the emerging markets sector completely for the time being because of the underperformance that it's been there. And this is the sort of thing that we keep an eye on a week-to-week basis. And when we think that trend is reversing, we'll shift the allocations within the portfolios, right? So if you're asking me kind of what I see going on within the market, Scott, I'm like, you're seeing it right now. You can see the little arrow on the chart. You can see this ratio or this chart, or what's called a relative chart, breaking to new lows, right? That is not a bullish sign in this case for emerging markets in relation to the S&P 500. Why is that happening, right? There's probably multiple factors that you can trace it, or why has that happened since about the 2011 timeframe? You can go back to the Russia-Ukraine conflict, right? A lot of emerging markets funds had a fairly high investment within Russia. Once that conflict arose, Putin said, "Thank you very much for these assets that you just gave me. Now please get out of the country." And a lot of those investments were more or less lost. Luckily, we were able to avoid that within our portfolios. But I think that highlighted a little geopolitical risk around the world that may be taking place. And we've also seen some capital flight recently out of China due to what's probably the banking crisis going on there with their real estate developer Evergrande and everything else that you see in the headlines. So even all the way to the point where, if you think about what emerging markets used to be, this is one of the things that gets talked about a lot is kind of, we were in a world of globalization where the emerging markets countries would basically build products for the more first world countries around the world and build up their own economies. Over the past couple of years, there's kind of been a theme that says, hey, there's a little bit of deglobalization going on. How long that lasts remains to be seen, but even an article that I was reading the other day kind of broke down what I would call our production line or production facilities taking place that used to be located in emerging markets countries. If I could back up there a little bit, maybe it's more around the AI and the robotics movement taking place. Because what we're getting, we've all heard of like the, being able to print, I don't know.
3D print,
3D printing, right. Yes, thank you. And so what's taking place, and to give you an example of this is, the process to build, I think it was Honda at the time. It doesn't really matter. I believe it was a Japanese car company of some sort. You used to, when they assembled their transmissions, it used to be you'd had to mill the steel for the transmission pieces and everything else, have it shipped in and assemble it in your factory, and away you go. As robots kind of take over in the process and this 3D printing is there, they're actually able to 3D print all of the parts that are in the transmissions for those vehicles now.
Interesting.
Which means you don't have the factory in the third world country. You have a printing press, maybe in some place like one of Amazon's warehouses, that can actually print that part and deliver it to you the next day. And so I think you're seeing a little bit of a structural shift away from how the world and how the emerging markets have kind of fit into the production flow. And I think that's being reflected in a lot of the stock prices. So that's a broad view, maybe, of how we look at our, kind of a little bit of a deep dive into our process a little bit, but also some analytics to say, we look at kind of what we think is taking place. At the end of the day, well, what that chart really tells us is money is still flowing out of those emerging markets and into domestic markets, and we need to shade our portfolios that direction for the time being until that flips the other direction at some point. And then we need to shade back the other direction. And we see much the same if you flip to the next chart that we've got in front of you. We've got the EFA index versus the S&P 500. The EFA index is a little bit more of a representation of probably European stocks. And we see a lot of the same thing going on there, right? The chart, still a very big downtrend over the time. Part of that's been due to the dollar. The dollar's been in a bull market effectively since 2009. That has a little bit of a bearing on that over time, but we're seeing a little bit of capital flight out of Europe at this point in time. So again, shading away from international investments and to those domestic investments at this point in time. So I think markets are always going to be volatile, Scott. You want to maintain some level of diversified portfolio, and like I said, I've been around long enough not to make predictions as to where we'll end the year, but that gives you a little bit of a glimpse of kind of how we're thinking about some of those asset allocation decisions within the portfolios.
Yeah, there's a lot of complex stuff going on there.
100%.
2020, adding complexity to that though, 2024 is an election year. How do elections look to impact markets?
This is a question that always comes out within our advisory group, and I think it comes out there simply because clients start asking it. I've been around for a long time, and every 4 years we kind of go through the same questions, I guess. Clients come back with the same questions is probably the best way to answer that. So when those clients come back with those same questions, you tend to have materials like this. And I think you found this one and actually showed it to our team here about a few weeks back, Scott. If you kind of look up on the screen, what this is showing you is over the last 80 years, here are the historical returns from the market in election years and then the year after the election. Okay. So to help you understand what you're looking at here, that first column says, here's the return of the market for the first 10 months of the election year, right? So the 10 months running up to the election. That next column, the middle column that says full election year, that says, here is the full year. So now instead of 10 months, I've got the additional 2 months tacked on after the election. And then the obvious one there is the year after the election. That's the full 12 months after the election. And if I can pick up any sort of pattern off of that, Scott, it's that you tend to have a little bit lower returns on average in an election year, still positive at the end of the day on average, but a little bit lower. And then once this makes total sense when you think about it, because the market hates uncertainty, right? What it wants is certainty, and then it can move forward, and kind of all the risk is therefore gone. And so what you see is those final 2 months of the year in an election year tend to actually almost double up the performance of the prior 10 months. And so that's not to say, hey, you should get out of the market here in the first 10 months leading up to that. But what it really is if you look at this, if you can pick a pattern there over one political party or the other, you're probably a smarter person than I am. But at the end of the day, if you're making your portfolio decisions based on how the election turns out, it's probably not in your best interest, right? Because even if you look at those full election year results, I think if you go back 25% of the time, so about 5 times after the election, you ended up with a lower return than what you did pre-election, right? So you go back to go back to 48. I think that was the worst performer there. Pre-election there was a 7.8% return. once you clocked in November, December, the whole market ended up being down 70 basis points.
Well, that was
really
kind of a shock that year. Truman won and he wasn't expected to. So
I think that's part of it. If you go through and look at the rest of them, two of the other five are basically break evens. And then the other two, and this is probably the bigger point to kind of bake into this, is in 2000 and 2008, those were the other two timeframes. So you got a Republican in one and a Democrat in the other. But if you really think about what was going on, similar to kind of your Truman surprise there, one was a popping technology bubble in 2000, and the other was a financial crisis in 2008 taking place. And probably neither one of those candidates was really responsible for what was going on. We've talked about it before, but the president tends to be a little bit like maybe the coach of a football team. Or the quarterback, would view it whichever one you can, but they take a little bit more of the blame when the market's up or down, I should say. So They take the blame when the market's down, and then they actually get a lot more credit when the market's up, right? And I think I saw a tweet by a candidate that's running right now trying to claim performance because he says the market thinks he's going to win here, which I got a good chuckle out of here the other day. So, you see both sides trying to claim credit for any sort of positive returns in the market. So at the end of the day, what I think the general point of this is you probably want to stay invested. You don't want to make your investment decisions based on, kind of an election result. Because if you look in the year after the elections, it's usually a standard return year, and it's much more driven on where we're at in the economic cycle versus anything else.
Okay. Pretty good analogy. Let's move on to interest rates and fixed income. And let's, give me we've seen a fast run up in interest rates over the last 2 years, and there's data that would indicate that interest rates are going to stay at current levels and possibly go up. There's data and talk on the street that interest rates will be cut sometime soon. Given that we want to keep this video under half a day, give us your perspective on what you see happening.
Yeah, if you had the magic answer, you'd be a very wealthy person on this. When we talk about this in our investment committee meetings, the one thing I think we keep going back to is you're going to see a chart in front of you of the 10-year yield. And so that's the 10-year Treasury yield. It's not bond returns. It's the actual percentage that is being yielded by the 10-year Treasury. And what you see there is basically, for anybody that's younger than me in this planet, I won't tell them how old you are, Scott, but I'll give myself up a little bit. Anybody older than me that's come here or onto this planet has never seen anything but a lowering interest rate environment. And that's what we've come to expect. Now, everybody watching at home that's older than me is going, that's not always the case. And, I remember times where that wasn't in place. And if you look at that chart, what I'll tell you is in post-COVID, that chart has broken the downtrend. So from a technical analysis standpoint, if you're strictly a chart person, they would say the trend is now shifted.
Yeah.
Is technical analysis everything? Well, obviously we try to build some sort of fundamental case of what's going on. But when that shifted, that created a lot of different dynamics, and we'll probably talk about that in the next slide. But we've had that spike up, but I think what we need to realize a little bit more is we might not be in Kansas anymore when it comes to bonds. That was a 40-year run in the bond bull market. This world does cycle back and forth. And at the end of the day, we may have started a different cycle. That doesn't mean interest rates are going to skyrocket tomorrow, or they may have just found a new level. But when we look at our portfolio and kind of how we're tackling that, we're still being cautious with any sort of extra duration risk because you can go back. I think we're getting a lot of different language from the Fed than what we've historically had, right? Federal Chair Powell has come in. even warned warned our politicians that the spending that they're have taking place is unsustainable.
Yeah.
That's not language you get in most most Federal Reserve meetings.
No.
We had a little bit of a banking crisis last year with the names of the banks are slipping me at the moment, but
Silicon Valley and
yeah, the Silicon
a couple
Valley
others.
Bank and about 2 or 3 others. And when you look at the charts on the yield, all of a sudden the market said, "Oh, here they're going to cut rates now," right? Because that's what we've been programmed to think for the last 40 years, and they didn't.
Mm-hmm.
And so, and now here all of a sudden in December, they came back and said, well, we're willing to think about cutting rates, right? And so we are seeing inflation abate a little bit. But on the flip side, you're seeing more geopolitical conflicts that could basically cause that to flare up again. So the Fed's doing the best that it can in the background, but I still think it's a time to kind of warrant caution and think about the fixed income portion within our portfolios a little bit differently than we have in the past. Because if you go to that next slide, this is a great slide from Jerry and Timmer of Fidelity. If you're a Twitter or in what's now called X, I guess it's not Twitter any longer. But if you're a Twitter person and you like this sort of stuff, make sure you're following Jurian. He puts out a lot of fantastic data. I get lost in it over lunch some days. But what you see here is basically, for the last 40 years, we've constructed what's known as kind of, the standard issue is a 60-40 portfolio for clients, right? 60% equities, 40% fixed income.
Yeah.
And what we got out of that was a diversified approach that, you took your risk with equities, but then your stable stuff was still earning you some sort of yield, but it protected you on the downside.
Mm-hmm.
Well, what happened post-COVID here is when those interest rates started to rise up, and you can see it on Jurian's chart that we're just starting to cross over where bonds and equities are now correlating together, meaning they're moving the same directions at the same time, and you're not getting the same diversification effect that you have been over the last let's call it at least 20 years, right?
Yeah.
And so it's charts like that give me pause to say, hey, we might be in a little bit of a different environment. We don't know what that environment is yet, but we need to be a little bit cautious in regards to going out and chasing long duration and being that. So at the moment, I wouldn't say we're in T-bill and chill mode, as I've heard it called, but we probably are hugging a little bit shorter duration within our portfolios because I've sat in investment committee meetings with Dave Bremer, kind of the founder of BFA here, and for the last 15, 20 years. And one thing Dave always said is, don't try to be a hero with bonds. And so if we're in a world where things are correlating together, that takes our 60-40 portfolio and makes it a 100 portfolio. Yeah. And we're not getting that diversification. So we have to find other ways to get that diversification because our clients have signed IEA agreements that say, hey, this is the risk tolerance or the volatility that I'm willing to accept within our portfolios. And we're doing our best to basically manage that aspect of things underneath the surface too. So I'd say the fixed income environment still warrants caution. I think it will eventually find its level, but I think for the capital markets to work the way they're supposed to, we need a normalized yield curve, and at the moment it's still inverted. So you're getting paid a little bit more not to take duration risk at this point in time if you kind of hug the front end of that curve. So
yeah,
there are starting to be some opportunities, but yeah, I'm sorry I interrupted you, Scott.
No, just to clarify, when we talk about short and long duration, we're talking about bonds that shorter duration means they're shorter maturities, and
Correct.
Usually we're focused on that because the longer bonds are not really paying any more return than the shorter ones. All right, correct?
Correct. If you think about the 30-year bond, I think as of this morning was about 4.3%. So is the 10-year bond. So is the 2-year bond, right? So that basically is implying the flat yield curve of some sort. And so while that kind of works itself out and finds its new level of sorts, I think we want to be cautious with our fixed income because that is the one portion of the portfolio that clients tend to think should be stable, and we're trying to keep it as stable as possible, right?
Yeah,
and in the meantime, for right now, we're getting paid a pretty good yield to do so.
Okay. Well, Well, we've given people a lot of things to think about, Chad, today. I appreciate you taking the time to cover all these topics with me, and we'll do it again sometime in the future if we don't replace you with some AI avatar chatbot thing. And
Well, yeah, if they get Chat BT or Chat GPT 27 or whatever, and they can put our avatars on here, that might make all of our jobs easier, and probably give me some hair at the end of the day too. So that'd be awesome as well. So, but thanks for
all
having
right.
me, Scott. I appreciate it.
You're welcome. And for all the people out there watching this, if you've got any questions about anything we discussed today, please reach out to your Boulay financial advisor. If you're interested in becoming a client or want to understand what Boulay financial advisors can offer you, reach us at learn more at bouleygroup.com. Until next time, thank you. Have a nice 2024.